What's up everyone, it's Scotty with MoneyVest. So this is going to be a macro update, and the S&P 500 flirting with just under 5,000 points for the first time ever is a huge milestone for the S&P 500, and I'm here to discuss and congratulate everyone, for all investors worldwide investing in the US markets, for being long, staying long, and of course not giving up for when things got tough back in 2022. Truly, honestly, if you're watching this video and you have gone through the entire bear market of 2022, congratulate yourself. Really be proud of yourself, because not a lot of people have the stomach to hold through the tough times. When things get tough and things get super challenging in 2022, there were bear markets, and we kind of witnessed it in real time. I was live. We were coming together every morning to watch the markets bleed and go down. It wasn't easy, but I remember those times, and it were good times because we were together supporting each other, and we were able to take advantage of the markets, dollar cost averaging, kind of plowing money into the markets. It was kind of like a fire pit. You're throwing money in the markets and it keeps going down. You're throwing money in the markets and you are in losses right away. And that was, of course, very tough times, but we pushed past it. We came through, and we are now hitting almost 5,000 on the S&P with a brand new all-time highs. There's a lot of things that are like going on, right? There's a lot of emotions, there's a range of emotions that have gone through, because I remember back then in 2022, we did polls asking, when do you think the markets are going to come back to all-time highs? Some people said 2024, some people said 2023, some even said 2025, 2026, 2027. Some expected the markets are never going to recover back to all-time highs. So of course, the sentiment was very bearish. The emotions were running high. So really a huge congratulations to all investors for sticking through with the markets here, and of course doing really well in the process. Make sure that you drop a like, subscribe to the channel if you haven't already. The links to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members only private videos. I did a video going over my top 12 stocks that I'm planning to buy with my buy targets, all the ETFs, all the tactical trades that I'm planning for in the future. So that's going to be down below with the link in the Patreon if you want to join. That's a members only private video. And also you do get access to all the Discord channels, trade alerts, binds alerts, options alerts, and also do connect with me on Instagram. My handle is going to be CAS@WRP as well. So going over to stocks, record highs persist as the S&P 500 flirts with hitting 5,000 for the first time ever. Just the strength of the U.S. markets are incredible, absolutely incredible. And not only the markets, but the economy as well. As economy continues to be on very resilient path, and we're seeing a very nice consistent uptick in the overall productivity. Not to mention the employment numbers are also coming in super strong. Now, one more thing I want to mention is that this is exactly the time when we have to be super cautious, because volatility here continues to be in this rare sort of territory where you'll notice that we are in the 16th percentile, meaning that we are really low on the VIX. Now, days under 20, it's kind of stayed 61% of the times, and this is going back, over 30 to 40 years, I believe, 8,514 observations. So 8,514 divided by 252 trading days, that's 33 years. So we're going back 33 years worth of data, and the number of days that volatility spends below 20 is the majority. Over 2/3 of the times, volatility is below 20. So this is very normal. However, days below 10 is when things get very interesting, and we haven't really dipped below 10 just yet. So you can see the difference between days below 20 and days below 10 is significant. I mean, 61% days below 20, but days below 10 is only 0.8%. So less than 1% of the times, volatility is under 1%. So meaning, said another way, most of the times in the last 33 plus years, volatility has been between 10 and 20. And right now, of course, we are at 12.8. We've stayed at these levels for a very long time, even though we are super rare at the moment. But this does not necessarily mean that we need to immediately start selling and start selling short and start buying puts, whatnot. Volatility can stay low longer than usual, then it can stay higher for longer, right? So basically what I'm saying is that we need to be super careful here. If it dips below 10, that's when that's going to be our big signal and our cue to be on the lookout for a potential spike and for the markets to drop back down. However, at the moment, we continue to be super strong in terms of the momentum, in terms of sentiment, and we are slowly and steadily kind of drifting higher and higher. However, that's also one of the reasons why I'm super cautious here, because this is the type of market that kind of sucks up all the liquidity. I can see and I can feel the greed in the markets at the moment, and that's exactly why I'm enjoying this moment. I'm enjoying where the markets continue to drift higher while also gathering some cash, also raising some funds to take advantage of those potential opportunities if and when they present themselves and they start coming down. This right here is the effective rate versus expectations. So what this shows us is that the markets are almost always incorrect in their assessment of where rates are going to be. You can see that 2005, 2010, 2015, 2020, and now 2023, 2024, every single time investors and analysts have expected rates to either stabilize, get cut, start raising, start going down, and almost every single time the markets have been wrong about where interest rates are going to be or have been in that situation. So in 2010, 2012, all the way through 2015, there were so many analysts expecting rates to increase and they never did. And then in 2020, they were expecting rates to either stabilize or get cut down, but there was a lot more aggressive cuts back then. And now a lot of investors and analysts are expecting significant rate cuts moving forward, which may or may not happen. Of course, nobody knows what the Federal Reserve is going to do, or the timing of those rate cuts, of course, is still uncertain. This right here is the 10-year treasuries and the market expectations versus actual reality. And again, you'll notice it's been fairly wrong in the last several years, in the last couple decades. Every single time the 10-year treasuries have expected to either go up or go down or go sideways, and the market's reality has been somewhat different. So I wouldn't read too much into a lot of these sort of expectations from analysts, because at the end of the day, as I mentioned before, nobody really knows what's going to happen, right? Nobody really can predict with any type of accuracy what's going to take place from a macro standpoint, from an interest rate standpoint, let alone from a market standpoint. So our job really is to understand what? Our job is simply to understand how well is the risk reward positioned in this market today. Is it worth buying in this market? Is it worth dollar cost averaging? Is the risk reward favorable to the upside or to the downside? What is the best thing to do? Because there's really not a lot that you can do in the market. You can either buy, sell, or you can hold and sit tight. And then, of course, with respect to options, you can start hedging a little bit and you can start protecting your positioning and kind of optimize your portfolio for cash flow as well. So there's not a lot that needs to go into that decision making. So our job is not to predict. Our job is to simply react to the current market, circumstances and constantly assess the risk and reward ratios as well. So seasonality snag, February is the third worst month for the S&P 500 on average in the past 30 years, and stock bulls are losing ground in pulse surveys. So we're starting to see a little bit of that decrease in the exposure from record highs in January as well. And that's fairly normal because we've seen a very strong rally since October 27th low from last year in 2023. The Magnificent Seven, of course, the concentration in these companies has increased significantly because of this is where everyone's flooded towards, and it's become a very overcrowded trade, in my opinion. And I think moving forward, I think there could be some potential for pullback. As we already know, it's been long overdue, and we are in this territory where the risk reward is very unfavorable, in my opinion. So where does that leave us, right? With all the information that I presented, talking about, of course, expectations versus reality, talking about markets hitting a new all-time high, bullish exposures starting to roll over a little bit, concentration risk is really high, and rate expectations are for 6 to 7 rate cuts in 2024. The bottom line is that a lot of that does not make any sort of importance, because at the end of the day, markets are going to do what they're going to do. Our job is to look at the risk and reward, and right now I can tell you that it's not that favorable because volatility is really low. S&P 500 is at an all-time high with an overbought RSI and a little bit of that negative divergence. So what I'm personally doing is simply selling calls, gathering more cash, because I know for a fact that the cash that I'm raising right now is going to be useful in a few weeks or a few quarters, because markets are going to give us opportunities. It's just going to happen. I just don't know when, but it will happen, and that's exactly what I'm prepared for if and when the markets do drop here. I will be ready to deploy more cash and be more aggressive in the markets, because that's how market cycles work. That's the nature of the market. We're not going to keep going up forever. There is going to be a time where we start to pull back, and you will be thankful. Trust me, you will be thankful for that time when the markets do come down and drop, that you had cash available, that you can start looking at deals and start deploying back into the market and be more aggressive at that time. So that's the strategy. That's the plan that I'm focusing on. Hope you all enjoyed this video, found it helpful. If you did, make sure that you drop a like. Don't forget to subscribe to the channel. Again, links to our Discord and Patreon is going to be down below if you're interested in joining and getting access to all the members-only private videos, trade alerts, trade ideas. Everything's going to be down below. The first week of the month is the best time to join, and I did open up a couple more spots if you're interested in joining. And as always, happy investing. I'll see you all in the next video.